Mr. Nolledo is the president and CEO of Xurpas. He started way back in 1999 when he founded PinoyExchange.com, and he's currently a board member, a director in Rappler.com, Gorango Software, and MyRegalo.com. And he's a founding director and former president of IMAP, which I believe is the Internet and Mobile Marketing Association of the Philippines, if I'm not mistaken. Mr. Nolledo.
Hello. Yay, okay, the microphone's working. I was actually quite nervous when I found out that Francis was the one who was going to introduce me, because Francis is one of my closest friends from college, and he could have added several more bullet points in his introduction. So let me tell you the story of Xurpas. I'll talk about our existing business and where we're headed. But first, I'll show you a picture of our first office. Yeah. So there's an advertisement for Coke Light right at the bottom. So yeah, when we were telling people that we started our business with the minimum amount of capital allowed by the SEC, it's because this is really all we could afford. All of the computers we brought from our homes to our office. My dad owned this 42 square meter space, so we didn't have to pay rent. The printer we brought. All we really had with us were our ideas and our dreams. That's really all we had. Since then, this was November 2001, we had never raised venture capital, nor had we ever gotten a loan. So from 62,500 pesos to IPO. When I say we've never even gotten a loan, not even from friends and family. So there was no point in the business where we borrowed from our families. And yet, over the years, we've developed the first mobile games. Before Facebook had ever been launched, we were doing social media applications. Before Instagram had ever been created, we were already creating photo applications. And before Dropbox had ever been incepted, we had already been doing storage for mobile content in the cloud. So what is our business really? Quite simply, we sell digital products to the mobile consumer. So classify us as e-commerce for digital goods. Central to our business model is the way people pay. The Philippines only has a 5% credit card penetration by head count, so you need an alternative currency in order to be able to charge consumers for the content, the products that you sell them. And because 90% of the Philippines is DE, we have to have a pricing model that makes our products affordable for consumers. So the way shampoos sell their wares to the consumers, they sell it by the sachet, not by the bottle. Same thing for us. We make our content very available to our consumers. So think of us as like a Procter & Gamble. We're a digital fast-moving consumer goods company. So in a typical traditional fast-moving consumer goods products business, you have 4 elements to a consumer purchase. The first part is the discovery phase. This is where, let's say, P&G wants to launch a soap called Safeguard. It's quite proud of it because it's superior in germ kill. It will do a lot of television ads so that a lot of awareness is created for the product. Consumer goes to the grocery, sees the bar of soap called Safeguard, and decides to purchase it because he recognizes that brand from the television ads he saw. Goes home, uses the bar of soap, and if he likes it, he might tell a friend, bumps into someone in the grocery the next time, and he says, you know, this is a really good bar of soap, go buy it. Now, this entire process may take weeks, if not months. For your phone, it can all happen, all 4 elements can happen in 10 minutes. So imagine a person discovers a very interesting piece of content on their phone, product on their phone. He has enough load, and so he purchases it directly. He enjoys the product directly on his phone, and if he likes it, he tells all of his friends on Facebook. So 10 minutes, all 4 consumer purchase elements, single device that you carry with you wherever you go. So think of Xurpas as an emerging market superstore. We go to sleep, we wake up, we sold more goods. Every phone is a store, is a branch, and we never run out of stock There's never a point in time a person goes to our store and we say, nope, that product is not available. And it's much easier for us to expand this business model across Southeast Asia. We don't have to buy trucks, we don't have to build warehouses, we don't have to put up physical establishments in order to expand our business. And we continue to innovate and bring new products to the market. So this is a smartphone game-based community. So as technology advances, so will we advance the platforms by which we build our products and services for. So our business model, I would describe it as a B2B2C business model. Here you have your digital content. We work with the telecom companies to reach all of the mobile subscribers. But then you start contemplating, as a percentage of the spend of every consumer's monthly budget, what percentage of that goes to digital goods? Quite small, right? The prepaid load. So the question is, what if Xurpas could access a customer's wallet beyond digital goods? So I'd like to talk to you guys about Storm benefits. So how does it work? I think there have been a lot of questions about this company and what the impact is to Xurpas. Storm benefits is quite simply any employee of a company we work with can convert their benefits into currency. An employee says, I don't really need all my sick leaves. I don't really need all my vacation leaves. I don't really need my telecom allowance, my Christmas basket, my fuel allowance. The only place they can spend this is our store. So it's a captive audience. It's a monopoly for the markets that we're in. And we already have quite the client base. And the business has been growing 500% year on year. The top line will actually blow Xurpas out of the water for the digital goods quite soon. And think about it. Storm built this with $100,000 paid up capital. And the primary founders didn't really know anyone. They had no connections. They were not called Xurpas. They built their business purely based on the merit of their product. So it's really solving e-commerce for an emerging market. So think about it. The same challenge we had selling our digital goods applies to physical goods, credit card penetration. Here, an employee's benefits becomes PayPal, the form of payment. Delivery, B2C e-commerce, 300 orders get sent to 300 locations. For us, it gets sent to one location, the company's office. There is no fraud because we're integrated into the HR system. We know every single person who transacts the service. And we have no customer acquisition cost. We close a call center, we have 30,000 new customers. We don't have to build a physical brick and mortar establishment. Benefits business, 2010, so that was 5 years ago, considering the economy has grown quite a lot since then, is 71 billion. And it's a business that we will expand across Southeast Asia and on to other emerging markets. Again, every time we enter a country, we are not just taking Xurpas games, we're also taking our physical products and services and all of the other applications and software to those other markets. Now we have perfect data on all the transactions, who buys what products people want, so that we can customize and create the right products and services for the right people so that we can delight them. Ultimately, we want to make every corporate employee satisfied and happy so that they can design something that's fit for them. So again, same business model. Now it's physical products. Now, instead of working with telcos, we've turned every company into a telco. And we reach every person who earns a wage. Our ultimate vision is to be the largest e-commerce player in emerging markets, and not just Southeast Asia. And we have a model that scales very quickly. So, in a nutshell, think of what Xurpas did with 62,500 pesos. We've IPO'd, we've raised a lot more money than we've ever seen. Now we're really taking it, we're really putting our pedal to the metal, and we're going to accelerate the growth of our business. You saw the core framework of what Xurpas does and is. There are several other products and services in the pipeline that will have the same philosophy. But at the end of the day, it will be all about driving products and services to as many consumers as we can reach. So thank you.
Very much. Congratulations on your very successful IPO. Um, just to let you know, I think I visited you once before your IPO
I
day,
remember. Yes.
and I was a personal witness to the droves of lines that were trying to subscribe to your shares inside, and no matter what it was, it didn't seem like to end. So again, very much congratulations
Thank
on
you.
that thing.
You know, we had no clue, honestly, what the reception of the market will be to Surpass. 2 months before the IPO, I remember our underwriter saying, you have to get out there. You have to get out to the press. You have to meet as many companies as you can, which for myself and my two other partners, we're very private people. It's not natural for us to actually go out. Like, I haven't presented to an audience of this size ever. So it's a new experience, and we're quite satisfied with what's happened, but at the end of the day, we're really focused on the execution of the business. I think what's interesting to note for all of you is I'm on the same boat as all of you. Surpass did not take a secondary offering, so meaning not a single peso that was raised went to our pockets. Number two, we had to increase our authorized capital a couple of months before the IPO because we did not qualify for the initial size requirement. What that means is that we have a 1-year lockout to sell our shares. So none of us trade our shares. So we're really focused on the long-term growth and opportunity that Surpass can provide.
All right, so let's start off with the question. Based on your disclosures, the bulk of the revenues come from Globe. Is Xurpas doing anything to be able to increase this revenue contribution in Smart or from Smart? And do you have any target in terms of proportion of revenues, and what timeline do you tend to achieve this?
Okay. When we decided to IPO, our company decided that our strategy was really to be global first, with Philippines as the launch pad. I think you've seen with our approach with Storm, every corporation is now a telco for us. You will see with our framework of a B2B2C approach that there are other telcos or other networks that we can tap using technology to access customers and businesses. So at the end of the day, we're building shopping communities. So with that mindset, we're really not conscious of what percentage should go to a particular network. Over time, once we are in multiple other markets, it will really be about how many people can we reach in as swiftly a time as possible, in as capital efficient a way as possible. So if 99% might come from a single network, so be it. Bottom line is we're focused on really growing our reach. The way to describe Surpass business is that we're only two components, content and distribution. So the more products we have, the more revenues we can derive on a per customer that we reach. And on the distribution side, the more customers we reach, the more revenues we can generate from the products that we have. If I had to choose which of the two I prioritize, we have an internal, sort of an inside joke in Surpass, that if content is king, distribution is King Kong. So our focus is really massive reach of users, and only technology can allow that.
I guess the focus of the question really has to underlie with risk involvement, assuming you're only with that one network and something were to happen. So has there been any particular thoughts in your mind to be able to try to be able to diversify that particular risk of a single network?
2 weeks ago when we disclosed Storm, and we couldn't really talk about the core philosophy of Surpass, and it was hard to talk about physical goods unless you saw what was coming, and you'll see what's more to come. One could make the argument that yes, 1/3 of the revenue came from one telco, and a little more than 2/3 came from another. But I think now you're going to see a revenue split that will actually be disproportionately weighed towards other types of corporations, and neither even the telcos. You're going to see the proportion of revenues coming from Globe to be going down over time, because suddenly there will be other telcos and other networks who are non-telco that will be deriving revenue from. I mean, think of it this way. One call center with 50,000 employees is worth our entire revenue for last year that we close. One conglomerate with 300,000 employees can increase our revenue 5x, 6x. So again, the thinking is very exponential. It's not, how do I now go from 70% reliance on Globe and 30% reliance on Smart, and how can I move that more to a 50-50? But rather, how do I accelerate the growth of the top line so that I'm able to generate a lot of data to allow me to bring better products and services to consumers.
Thank you. May we have the next question, please? All right, if you don't mind.
Sure.
Why were your third quarter 2014 revenues and earnings growth significantly lower compared to recent historical growth? And would this be taken as a sign that growth of your core business is tapering moving forward?
Okay. I'd like to give you guys an analogy of how Xurpas works. I mentioned earlier a P&G analogy for digital fast-moving consumer goods. I'll use Nestle this time as an analogy. So every time a grocery shopper goes to a grocery and buys items for their home, they're probably going to buy 6 products, Nestle products, and that's going to be in their grocery bag. For Nestle to grow its revenues, it has to do 2 things. Number 1, it has to introduce new product lines. Its focus isn't really, how do I eat an additional 5% market share for coffee, for Nescafe? Its thinking will be, how do I launch a creamer that will complement users who buy Nescafe? And I'll call that Coffee Mate. Or maybe some of the people who purchase our grocery products also have pets at home. So they'll create a product called Alpo so that they can start cross-selling dog food. So we're quite similar. For us to grow our digital content business, we have to launch new products to our consumers. But you can see, our consumers don't really buy lesser of our old products. But there's only so much a consumer would be interested in, for example, from a sticker pack, a mobile sticker pack. And there's only so many consumers who'll buy. And over time, as smartphone penetration accelerates, perhaps more will buy, but we're going to have to introduce new content and product communities to them. The second way Nestle will grow is it has to now reach more groceries, more sari-sari stores in more markets. Same thing for us. We did not add a new telco in our third quarter. So having said that though, something like Storm and something like I showed you, the smartphone games community, for the first time ever, we're going to launch a product that will address smartphone users. Because a lot of our content is actually browser-based, feature phone-based. So again, now that we have more resources to put the pedal in the metal and launch these products, even our investment in Altitude Games suddenly gives us so much competency when it comes to building smartphone-based content. So again, content and distribution, every time we make an investment, acquire, or partner with someone, it's either to make our content better or make our distribution more efficient.
Thank you. Next, please. What is the size of the expected earnings contribution of Xurpas' recently acquired Altitude Games, PTE Limited?
So Altitude Games were founded by 5 people, combined 60 years of experience building games for first world markets. Like the former CTO of Gameloft, a guy who used to work in electronic arts, and so on and so forth. Philippines has a very strong knowledge process outsourcing base. We have a lot of talent who builds products. Unfortunately though, they build it for Western companies who then sell it in Japan, US, China, and what have you. So Altitude Games is really putting together the best talent who've been building games for other companies are now going to build games that are Philippine originated, our own IP. As we focus on the distribution, on expanding our distribution and our reach, they're going to give us the best content. So our investment in Altitude Games comes with it the exclusive distribution rights for anything they produce in Southeast Asia. At the end of the day, we're probably going to see 20 to 30% of our digital content revenue coming from smartphone users, whereas last year, it was probably less than 3-4%. And Altitude Games will be a significant contributor for that.
Is this in the future, or have they already produced something that is showing you a semblance of what that success would be?
So we launched an alpha version of Run Run Super 5 here in the market. It's actually running in other app stores, not just the Philippines. It's actually running already in Bangkok, and it's already running in Indonesia. So we're already testing the metrics. And we're quite satisfied with what the response of the market has been here. Because with the smartphone, you're able to launch a product outside of just your market because you go to an app store environment.
Next, please. Regarding the recently acquired Stormflex Systems, what is your basis for the previously disclosed 71 billion market potential for storm service?
2010 numbers are the basis. Total compensation for all employees recorded in the Philippines was a little over 800 billion. Total, as a percentage of that, salaries was a little over 700, was over 700 billion. The difference is 71 billion. That's benefits. That number is probably much higher today, as that was a figure that was 5 years old.
We understand that Storm is partly owned by yourself. Can you tell us how the purchase price for the company was determined? More importantly, can you share with us Xurpas' criteria in acquiring new companies, their valuation, profitability? What steps does Xurpas take to minimize risk for the company and its minority shareholders?
Okay. Number one, I wanted to make it clear to everyone, I am actually a minority shareholder in Xurpas. I own only a fourth of the company. So that's one data point. The second data point is the majority shareholders of Storm were two individuals, Peter Cotton and Paulo de la Fuente. There was a minority stake held in Storm by a third company called Ace Solutions, of which I am a shareholder, but I am by a mile not the only owner. There are several shareholders on record for that company. When Storm was introduced to Xurpas, I inhibited myself from voting. So my partners in Xurpas and our board of directors, I think, would not do the deal if they did not see the potential that Storm would bring. And I think after I explained to you guys what Storm does, it's hard to argue that. From a valuation perspective, so Storm was acquired for 4.3 million US. 2.3 million US of that went into the company and did not go to buy out existing shareholders. So actually more than half of the purchase price went into the company to be used as working capital and expansion capital. Why did we have to put in a total of 4.3? It was important for Xurpas to own 51%, a controlling share of Storm. So Paulo de la Fuente and Peter Cotton, they didn't really want to get diluted beyond 51%. I mean, they didn't want necessarily a third party to own a controlling share in the company. So the valuation was really based on, but they needed capital to grow. So they were raising money, and there were 3 VCs, 3 international venture capital groups who were supposed to come in for a minority stake in the company and had established, in fact, a higher valuation. I had to convince them, as well as my board, to convince them that they had to take a larger dilution at a smaller valuation. So, but bottom line, the core valuation of Storm is actually less than 1 times the revenue they'll do this year. So, from a pure valuation perspective, if a third party had acquired Storm instead, I can guarantee you the amount would have been much higher than what Xurpas paid for it.
All right, so how do you plan to be able to, dynamically grow the company in the next few years? And can we expect the same level of growth to continue? I think your margins are incredibly up there, and I guess that's a tough act to push on every year.
Our margins were the way they were because we really manage our costs very efficiently. But admittedly, there were certain key management positions that we didn't have prior to listing. And we are really investing in getting the best human resource talent to drive our business forward, to make sure that we're also scalable from a skills perspective, not just from a business model perspective. Our focus is really top line now. When we enter other markets, we're going to be investing, although still efficiently, capital to make sure we have the infrastructure to scale in those markets. And our ability to, and I guess the way to look at it is, think of a physical product business. For a physical product business to grow, they're going to have to build more boxes, more malls, for example. It takes time to build those malls, but once they light up, and if it's in a good location, there are people who are going to shop there and drive their revenues, their leasing income, for example. It's going to take time for us to establish a presence in multiple markets, although some will be much faster, sooner rather than later. But it's nowhere going to take near the same time as it would for us to build a building or a physical structure. I mean, it's not going to even be close. Sign a contract with a major operator in a location, and you pretty much have a new country. Get a few core businesses to sign up for us to deploy our benefits marketplace in that location. You essentially have another country. Now, our core B2B2C model does not stop with what you guys see. There are several other efficient ways where technology can go directly to a consumer, cutting out all of the middlemen, where we don't have to spend to acquire these shoppers, these consumers. Our perspective of growth is really several multiples of our growth before. But it's not going to happen quarter on quarter on quarter, where now he grew 500% this quarter. Because if a B2B2C model has a B2B before you go to the C. But once you convince a network to plug in, your revenue grows up exponentially. It's not even by factors of 10, 20%. It's factors of 100, 200%.
All right, I think our time's up, but if you don't mind, I'll sneak in one more question, if you don't mind.
Okay.
Should we expect maybe another acquisition in the next 1 or 2 years?
1 or 2 years is too long.
All right. Ladies and gentlemen, let us thank again Xurpas.
Thank you. Thanks,
Thank you
everyone.
again, Sir Nolledo.